Welcome to this explainer. Imagine for a second a literal floating fortress. We're talking about a massive, multi-million-dollar commercial vessel that's out there navigating the unpredictable and, let's be honest, often violent dangers of the open sea. So how do you protect an investment that size from complete financial ruin? Well, the answer lies in a very specific, highly traditional form of financial armor. It's known as hull and machinery insurance. Today, we're going to dissect the entire anatomy of this maritime shield. Okay, let's dive into this. Here is our voyage map for today. We'll be breaking down the hull and machinery shield, calculating the insurance premium, navigating perils and exclusions when massive ships collide, and finally, we'll wrap up with deductibles, rules, and terminations. Let's get to it. Section 1. The hull and machinery shield. Now, while hull and machinery are technically two different words, in the maritime world, they basically fuse together to form a single unified insurance shield. You'll almost always hear folks in the industry call it H&M insurance. So how does this actually work? Well, H&M insurance typically operates as a time policy. That just means it covers the vessel for a specific time frame, usually exactly 1 year, and requires an annual renewal. But here is the absolutely crucial part. It's a valued policy. This means the total value of the vessel is explicitly agreed upon between the shipowner and the insurer right out of the gate. If the worst happens and the ship sinks and is declared a total loss, there's absolutely no arguing over depreciation. The insurer simply pays that exact agreed-upon upfront amount. The whole shebang. Moving right along to Section 2, calculating the insurance premium. So how do insurers actually price such massive risks? I mean, they aren't just pulling numbers out of a hat, right? They rely on a highly specific set of rating factors. They look at the ship's type. Is it a bulk carrier or maybe a tanker? They check out the tonnage and the age of the vessel. They map out its trading pattern. Crucially, they look at the flag of registration. A flag of convenience, for example, might signal a totally different level of maintenance to an underwriter. They verify the vessel's classification, and, this is a big one, the ship owner's past claim record. If you have a history of accidents, even on other vessels in your fleet, your price is going up for sure. Finally, higher deductibles, where the owner agrees to eat more of the initial risk, will bring that premium down. To really wrap our heads around this, let's do a little bit of math. I want you to picture this. You own a commercial vessel, and you and the insurer have agreed on a valued policy of exactly $4 million. Let's break down how that calculation shakes out. Your premium is built on two distinct elements. First up is the total loss, or TL element, which is calculated as a percentage of your ship's overall value. In our scenario, a 0.75% rate on your $4 million ship equals exactly $30,000. Easy enough. The second part is other than total loss, or OTL. This is usually calculated based on the sheer size of the ship, its deadweight tonnage. Here, a rate of $1.25 per ton on a 30,000-ton ship gives us $37,500. You just add those two buckets together, and your total premium sits at $67,500. When you step back, that ultimately works out to a 1.6875% rate on the total insured value. Pretty fascinating to see it broken down like that. Section 3. Navigating perils and exclusions. Now, what's really interesting about this slide is we finally get to see the actual weapons this shield protects you from. The perils are basically split into two camps. On one side, we have the classic perils of the sea and acts of God. We're talking random, fortuitous disasters, heavy weather, raging fires, piracy, violent theft, earthquakes. These automatically covered. But then on the other side, we have conditional perils. These involve human and mechanical slip-ups. Think bursting boilers, hidden machinery defects, or just flat-out negligence by the master or crew. Now, these are only covered if the shipowner can prove they exercised due diligence. Meaning, if the shore management was asleep at the wheel and negligent themselves, boom, the shield drops, you're on your own. Let me share a quick story about why those conditional perils even exist today. Get this. Back in 1887, a vessel named the Inchmarie suffered some major damage. A repairer accidentally closed a valve, which caused a massive pump to burst, and seawater just flooded into the ship. The owner obviously filed a claim, but the courts actually ruled that a repairer's dumb mistake was not a peril of the sea. The claim was completely denied, zero payout. As you can imagine, the shipping industry was absolutely floored by that ruling. But because of the Inchmarie disaster, underwriters had to adapt, and they created what is famously known to this day as the Inchmarie Clause. This was specifically injected into the standard policy to guarantee that owners are protected from the blunders of their own crew or repairers,
and from latent machinery defects, provided, of course, the owner themselves wasn't acting negligently. It was a real game changer.
Another wild addition is the pollution hazard clause. In one historical incident, a heavily damaged vessel called the Tony Canyon posed such a massive, catastrophic environmental threat that the UK court literally ordered the vessel to be bombed and destroyed to prevent widespread pollution. Seriously, the H&M policy will actually cover the loss of the vessel if a government takes that kind of extreme, drastic action to prevent a pollution hazard, as long as the owner tried their absolute best to stop the pollution first. But hey, we have to remember, this shield isn't totally invincible. Here is a brisk look at what the policy absolutely does not cover. At the very top, we have paramount exclusions that just override everything else. Damage from war, torpedoes, strikes, terrorists, or, heaven forbid, nuclear weapons are immediately excluded. Plus, your standard exclusions apply too. If the damage is caused by the willful misconduct of the owner, simple delays, or just everyday wear and tear, the insurance isn't going to pay a single dime. Which brings us to Section 4, when massive ships collide. And this brilliantly illustrates the sheer chaos of ship-to-ship collisions and how the maritime industry handles it through something called the running down clause. If your ship is legally at fault for hitting another vessel, your H&M policy steps up to cover the damages, but only up to 3/4 of the claim. Historically, insurers intentionally left out that final 25%. Why? To force ship owners to be extra careful, keeping some skin in the game. Today, shipowners usually bridge that risky gap by having protection and indemnity, or P&I clubs, cover that remaining 1/4. But what happens if both ships are at fault? Well, it gets kind of messy. This brings us to cross liabilities. Let's say Ship A suffers $100,000 in damage and Ship B suffers $60,000 in damage, and the courts decide they're equally to blame. Ship A doesn't just pay for its own mess. Ship A is actually liable for 50% of Ship B's damage, which is $30,000. Conversely, Ship B is liable for 50% of Ship A's damage, which is $50,000. The whole policy actually steps in to cover these specific cross-liability payouts, subject to that 3/4 rule we just looked at. Let's wrap up with Section 5, deductibles, rules, and terminations. Let's start with deductibles. The logic here is actually pretty straightforward. Deductibles keep those expensive administrative nightmares, small claims, far away from the insurers, and they financially force the shipowner to maintain high safety standards. Deductibles will reduce the payout for partial damages, collisions, and salvage. But there are a couple of notable exceptions. If your ship is a complete total loss, the deductible goes out the window. It's not applied. Also, if your ship runs aground and you need to pay divers to inspect the bottom of the hull, the insurer covers that cost without a deductible, even if they find zero damage, just to heavily encourage those vital safety checks. Here's a super quick look at how that acts as a strict threshold. If you have an agreed deductible of $10,000 and you file a partial damage claim for $9,000, your payout is literally zero. You absorb that whole cost. But if your claim comes in at $12,000, the insurer just lops off the $10,000 threshold and writes you a check for that $2,000 overflow. Now remember how we said earlier that this is typically a 12-month policy? Well, insurers rely heavily on consistent, predictable oversight. If the risk profile changes drastically mid-year, that shield drops instantly. The exact triggers that will immediately terminate your H&M insurance include changing your ship's flag, having your classification withdrawn because of sloppy maintenance, changing your management company, or leasing the ship out on a bareboat charter where you totally hand over operational control. If any of these happen, your policy's instantly voided. Let's move to and see how this builds over time, because the rules governing all of this are constantly evolving. Back in 1983, the London Market codified the standard Institute time clauses. Then, in 1995, these were aggressively updated to mandate strict compliance with classification and new safety management codes. Fast forward to 2003, and they introduced the International Hull classes, which expanded the rulebook to 50 incredibly detailed provisions just to match the sheer complexity of modern global shipping. The insurance market literally never stops adapting. Which leaves us with a final, somewhat provocative thought. We've seen the math today, we've walked through the clauses, the inclusions, the exclusions, but if the sea is inherently unpredictable, just full of fortuitous, random accidents, and human error from crews and repairs is practically inevitable, can a floating steel fortress ever truly be fully shielded from risk? Hull and machinery insurance absolutely offers the best financial armor money can buy, but out on the open ocean, the delicate balance of risk management is never completely solved. Thanks so much for joining me on this explainer. I hope you found it as fascinating as I do.